What if I told you that I've got a strategy that allowed me to multiply my portfolio by 5 in just 2 years? Sounds unbelievable, right? Well, it is true. In this video, I am going to share with you the exact strategy that I've been using in the crypto market. One that has helped me grow my initial investment 5 times over in just 2 years. And the best part? It's not some crazy gamble or get-rich-quick scheme. It's a simple, steady approach that anyone can use, no matter how money you start with. I am talking about the DCA, dollar cost averaging. A strategy so powerful and so easy to implement that it could change the way you think about investing, especially in volatile markets like Bitcoin or the stock market. I've been applying this method to my own portfolio since 2021, and now I want to show you exactly how it works, how I use it to get more Bitcoin at a lower price, and why it is the key to building wealth over time. Hello, my name is Enrique Alcaraz. I am an economist graduated in La Sorbonne and also a professional trader. And today I'm going to explain you how you can start using this strategy from now, whether you're new to crypto or already have some experience under your belt. I also share real examples from my own portfolio, showing the exact entry points I use to multiply my holdings. So, let's dive in. But first, let's define what is DCA. DCA, or dollar cost averaging, is an investment strategy that involves consistently buying an asset over time, rather than investing all your money at once. The idea behind this approach is simple. By spreading out your purchases, you can minimize the impact of short-term price fluctuations and reduce the risks associated with market volatility. Instead of trying to time the perfect entry point, which even professional investors struggle with, DCA ensures that you invest regularly, regardless of whether the price is high or low. This eliminates the stress of making a large purchase at the wrong time and allows you to benefit from both market dips and recoveries. There are several key advantages to this strategy. First, it helps smooth out price fluctuations, ensuring that you don't end up buying everything at a peak. Second, it removes the emotional aspect of investing. Many people panic and sell when the prices drop, or FOMO, fear of missing out, into the market when prices are skyrocketing. DCA eliminates these emotional impulses by enforcing a structured and a systematic investment plan. Third, this strategy allows you to take advantage from the market downturns. When prices fall, you're buying more for the same amount of money, improving your overall cost basis. To illustrate how DCA works, let's look at a simple example. You've got two scenarios. Scenario A, you invest all $1,000 at once when Bitcoin is priced at $40,000. So if the price drops right after, you will suffer an immediate loss. Or scenario B, instead of investing everything at once, you split your $1,000 into 5 smaller investments of $200 each. You buy Bitcoin at different price levels: $40,000, $35,000, $30,000, $25,000, and $20,000. To illustrate this more clearly, let's calculate the average purchase price in both scenarios. First of all, we've got scenario A, where the investor buys $1,000 worth of Bitcoin at $40,000. This means that their average purchase price is simply $40,000. On the other hand, we've got this scenario B, where the same investor, splits the $1,000 into 5 separate purchases at $40,000, $35,000, $30,000, $25,000, and $20,000. The average purchase price is calculated with this formula, this equation right now, that gives us a $30,000 average price. This means that in scenario B, the investor's Bitcoin holdings cost an average of $30,000 per Bitcoin, instead of the $40,000 per Bitcoin in this scenario A. This $10,000 price average per Bitcoin purchased is a direct profit. This concept of average purchase price is key in investing. By using DCA, the investor ensures that they are not exposed to the risk of buying at the peak price. Instead, they accumulate their asset over time and at different price levels, lowering the overall purchase cost and improving potential returns when the market recovers. The best part about DCA, you don't need a lot of money to get started. Whether you can afford $10, $50, or $100, this strategy works at any budget level. The key here is consistency. Over time, these small investments compound into a significant holding, without the stress of trying to predict the market's movements. But how can we apply this to reality to make money? Actually, I'm going to add another rule that you need to apply. The key to making money with Bitcoin isn't just investing regularly, it's investing smartly. And not only in Bitcoin, also in any stock in the market. Many people get caught up in this cycle of buying at the wrong time. They enter the market when prices are high, only to panic and sell when the price drops. This reaction is completely normal and is driven by emotion. And it's one of the main reasons why so many people lose money in crypto. Instead of falling into this trap, I use Bitcoin's volatility to my advantage. Rather than buying Bitcoin randomly every week, I follow one simple rule. I only buy when Bitcoin closes the week in red. This means that at the end of each week, I check if Bitcoin's price is lower than it was in the previous week's close. If it is, I invest a set amount, whether that's $20, $50, or $100 depending on my budget. If Bitcoin closes higher than the previous week, I don't buy at all. Hands up. Don't do anything. This ensures that I am always buying at the better price points rather than getting caught up in price surges. Or, in other words, highs. Strategy is effective for two main reasons. First, it allows me to always buy the dips. Instead of worrying about whether I'm investing at the right moment, I let the market dictate my buying decisions. When Bitcoin drops, I buy more. When it rises, I simply hold and wait for the next dip. Over time, this ensures that I accumulate Bitcoin at a lower average price compared to someone who invests without a structured plan. Second, this approach removes the emotional stress that leads so many people to make bad financial decisions. As I said before, when the prices drop, inexperienced investors often panic and sell at loss. When prices rise, FOMO kicks in, and people rush to buy at the top. Both of these behaviors can seriously harm long-term financial growth. By following my rule, only buying when Bitcoin or any stock closes in red, I eliminate these emotional mistakes and stick to a logical, data-driven investment strategy. Over time, this has allowed me to accumulate Bitcoin at great prices, significantly improving my average purchase price and maximizing my long-term returns. Right now, these returns are, as I said in the beginning of the video, around times 5 the initial amount and total amount that I put in the beginning. If you're looking for a low-stress, high-efficiency way to invest in Bitcoin, this is the method that has worked the best for me. Once you've started accumulating Bitcoin using the DCA strategy, the next important step is ensuring that your holdings are secure. One of the biggest mistakes new investors make is keeping their Bitcoin on exchanges, leaving them vulnerable to hacks, platform failures, or withdrawal restrictions, like the one that we had with FTX. If you don't control your private keys, you don't truly own your Bitcoin, so you don't truly own your money. The safest way to store Bitcoin is by using a hardware wallet, and one of the most reliable options available is the Ledger Nano S. I'm going to show it right now. $1 here. This small USB-like device provides an extra layer of security by keeping your private keys offline, protecting your assets from hackers and unauthorized access. Look at it. It is like this. And this one is from Ledger, as I said. You will have the link down in the description, by the way. Using Ledger Nano S is quite simple, but if you want, I can make a video on how to manipulate it and how can you transfer Bitcoin from your exchange to, in this case, this wallet. The other option you've got to buy Bitcoin is through an ETF, for example, from BlackRock's. In this case, if BlackRock owns your ETF or if you buy it through BlackRock, you won't own your Bitcoin. So it won't be truly yours. You will buy a contract saying that you've got that Bitcoin. You won't actually have that Bitcoin. By the way, this is not a sponsor recommendation. I am a tiny channel. I'm simply sharing what I personally use to store my Bitcoin because I truly believe it's the safest option available. There are other companies, but in this case, I use Ledger and I use the Ledger Nano S. It has been my go-to choice for all this cryptocurrency journey, and I highly recommend it for anyone serious about protecting their assets. If you're interested, as I said before, I'll leave an affiliate link down in the description and the first comment that would help me with this channel. You can collaborate in this channel. But now a new question arises: how much should you put in Bitcoin? In this case, it depends all on your budget. In this case, you should look for an amount that you can put on a regular basis and that sticks into your portfolio strategy. I made a video, my last video actually, where I talk about how to build a portfolio from zero depending on your risk profile. In that video, I help you identify your risk profile and how much or what percentage should you invest in stocks, in Bitcoin, or in other safer investment options that actually are kind of innovating. So I recommend you to watch that video in order to take better decisions, more informed decisions in this case. But regardless of how much you invest or how much you decide to invest, in this case in Bitcoin, there is just one golden rule you should always follow. Never, and I repeat, never invest money you need in the short term. Bitcoin is a long-term game. And while the market will have ups and downs, history has shown that patience and consistency pays off. Those who stick with it and avoid panic selling are the ones who benefit the most over time. By focusing on consistency instead of market timing, you take the stress out of investing, whether you're investing in small amounts or large ones. Following a steady plan is what ultimately leads to success. And I can tell you this because I've been investing for over 4 years now. That's almost all my professional career. And for real, this is the best part or the best advice that I can give to you is stick to this strategy and go for the long term. In this case, I'm a trader, but I do not trade cryptocurrencies because they are very volatile and I basically lose my mind. But now I want to make a point, because while this strategy works exceptionally well for Bitcoin, it is not limited to just cryptocurrency. DCA actually is a powerful approach that can be applied to many different assets, making it an excellent choice for investors looking to diversify their portfolios. I personally use it to invest in stocks, Bitcoin, and basically everything I do, I use the DCA strategy. And you may be wondering, oh, but what happens if the market keeps falling? What happens if we enter in a bear market? Actually, bear markets are one of the biggest challenges, especially in terms of mindset, in terms of psychology. Many people, or most people, actually panic and rush to sell, fearing that prices will continue to decline. However, history has shown that bear markets are actually the best opportunities to accumulate assets at discounted prices. I've used this to buy Bitcoin and achieve an average price of around $25,000 to $30,000. And in this case, if we look at Bitcoin's past cycles, every major dip has eventually been followed by an all-time high. In this case, I believe the 2022 global market kind of recession, it's not a recession, but it went down around 50%. Right now, there are still some opportunities still in the stock market, but at that moment, that was a key moment that was essential to buy. And thanks to that moment, I was able to get good average price for Bitcoin. In contrast, if you panic sell, oh no, I don't want to keep up with this strategy, you can often miss these massive opportunities. In this case, I've seen Bitcoin in 15,000 and my last price that I bought is on 20,000. Fewer than that, I was like, maybe it can continue falling. But it didn't. It just rebounded. did a massive rebound. And in this case, and I learned that when prices start to rise again, you should not buy because you will have a great average price with this DCA strategy. So my best recommendation is when times of fear and when times of crisis come, just keep on with this strategy. Keep consistent because in the very long run, it worked for me and it may work for you. So there you have it, the DCA strategy that has helped me multiply my Bitcoin holdings while avoiding the stress of market timing. This method is simple, effective, and accessible to everyone, whether you're a complete beginner or an experienced investor looking for a structured approach. The key takeaway? Consistency, as I've repeated multiple times in this video. By sticking to a disciplined plan and continuing to invest regardless of short-term market fluctuations, you're setting yourself up for long-term success. If you found this video helpful, make sure to hit the like button. It really helps to spread the message and support the channel. I also encourage you to subscribe so you don't miss out on future videos. In this case, FOMO is necessary in my channel because you don't want to miss any other video where I can explain good strategies in finance, investments, but not only in those two, also in economics and other theories that could be very interesting for you and your knowledge. Also, if you want to dive deeper into how to pick the best investments, I highly recommend checking out my previous video, as I said before, where I explain how to build your own portfolio. You can find it linked here on the screen right now and also in the description below. Thanks for watching, and I'll see you in the next video. Ciao.